If you've been waiting for multifamily to unfreeze, 2026 is the year it starts to feel normal again. And we're seeing transaction volume pick back up, vacancies tightening across major markets, and policy signals tell me that housing is finally going to get help, not headwinds. So in this video, I'm going to walk you through what actually moves cap rates, what I expect from multifamily and syndication in 2026, and how to position yourself so you're not chasing deals after everyone else wakes up. Hey, I'm Matt Picheny, international speaker on real estate, author of the best-selling Backstage Guide to Real Estate, featured in Forbes and Fast Company, and videos like the one you're watching right now are designed to help you scale up with syndication. Now, just a quick reminder, everything I share is educational. This isn't investment, legal, or tax advice. Everyone's situation is different. Your state, your lenders, your investors, your goals. So use this information as a guide and always consult with your own advisors. All right? So let's jump in. For the past few years, I've released annual real estate prediction videos for 2024, for 2025, and now for 2026. If you followed those, you know I don't just make hype videos. While a lot of people were calling for massive buying opportunities a couple of years ago, I told you that I just didn't see it yet. The math didn't work, the debt wasn't cooperating, and sellers hadn't adjusted to the new reality. But as we move into 2026, it feels different. The data and what I'm seeing firsthand tells a new story. Where we're coming from. The last few years in commercial real estate were rough. Interest rates spiked, deals that penciled in 2021 no longer worked, and buyers and sellers were completely disconnected. But now we're seeing some shifts. Transaction volume is rebounding. We're no longer stuck at those 2024 lows. Deals are happening again. Sales volume is up, and the market has finally found a clearing price. Vacancy rates are tightening across the top 50 markets, meaning demand is catching up with supply. And that matters because of the next point, and this is what just about everybody gets wrong. The big misunderstanding. A lot of people think interest rates down means cap rates down, which equals values going up. It sounds simple, but it's not accurate. History shows plenty of times when interest rates dropped and cap rates actually rose, or when interest rates climbed and cap rates stayed flat. The two move together sometimes, but not always. What really drives cap rates down is transaction activity. It's simple supply and demand. When deals are happening, competition increases, confidence returns, and cap rates compress. So the question for 2026 is, will that activity continue to grow? And my answer, absolutely. And that's prediction number one. Prediction number one, 2026 is the year where volume feels normal again. We've already bounced off the bottom in both loan originations and sales activity. Buyers, sellers, and lenders are finally starting to align again. As transaction volume increases, cap rates will start to compress a little, not because of interest rates alone, but because real deals are happening. So that's my first prediction. 2026 will see higher multifamily transaction volume than the 2024-2025 slowdown. So that increase in volume will compress cap rates and slowly begin to lift property values. Prediction number two, policy will turn pro-housing. We're seeing growing pressure on Washington to address housing shortages. There's even been talk of declaring a national housing emergency. And when the federal government starts using language like that, it usually means incentives, subsidies, or new lending programs are coming. I mean, look, they're even evaluating a 50-year mortgage right now. And I don't know what the final outcome of that will be, but they're clearly looking at different options. Now, add to that, a new Fed chair is expected mid-year, and we've got an administration that is focused on stimulating growth and lowering rates. So if you put it all together, it looks like 2026 is a year where policy favors housing and development rather than restricting it. And remember, usually the biggest opportunities go to those who are already active when those tailwinds arrive, not the ones who start afterwards. Prediction number three, debt gets more cooperative, not cheap. 2026 probably won't bring free money again, but it will bring relief. Expect slightly better rate terms, more lender appetite for multifamily, and more flexibility for value add and bridge deals that have been tough to pencil in the past couple of years. A more stable debt market, combined with higher transaction volume, is the real foundation of recovery. Far more important than watching what the Fed does from month to month. Prediction number 4, the distress window starts to close. 2024 and 2025 brought plenty of distressed opportunities. Broken capital stacks, maturing bridge loans, sellers under pressure. By the end of 2026, I think much of that will have worked itself out. There will still be deals, but the deep discount window is closing. If your strategy is to wait for the crash, that moment's already passed. 2026 is about buying good assets at fair prices in a stabilizing market. Prediction number 5, operational excellence will drive returns. As the market normalizes, the differentiator won't be those who bought at the deepest discount, it'll be those who run the properties the best. The operators who focused on efficiency, sustainability, and resident experience will win. Think green upgrades that cut expenses, smarter property management systems, better communication and retention strategies. Those sponsors will attract capital faster, get stronger loan terms, and command higher exit prices because performance stands out in a market that's healing. What to do if you're a syndicator? Here's how to play offense in 2026. First, build your team now. My partners and I is still the most powerful phrase in multifamily. Brokers care more about your ability to close than your offer being slightly higher. Number 2, know your structure. Understand 506B versus 506C, investor rules, and your compliance game plan before you raise a dollar. Number 3, stay visible. Deals flow to people who are out there, sharing value, networking, posting, teaching, and showing they know the business. Number 4, underwrite for today, own for tomorrow. Don't try to time the market. Buy on today's numbers, and 2026 improving fundamentals will do some heavy lifting. Most of my students are submitting offers within 90 days once they focus, but closing that first deal often takes up to a year because relationships and trust take time. That will still be true in 2026. Now, if you want to know how to find, structure, and fund your next or your first syndication deal and how to put yourself in a position to capitalize on this next phase of the market, I've got a simple roadmap to get started. It's free. Just use the link in the description below or visit scalingupwithsyndication.com. But here is the bottom line. Volume's coming back. Cap rates are starting to ease. Policies turning pro-housing. Debt's becoming more flexible, and the distress window is closing. And remember, it's not about timing the market. It's about being in the market when it turns. Now, I'm not saying this is going to be the most incredible year, but if you're serious about multifamily or syndication, 2026 is the year to lean in, build momentum, and position yourself for the next cycle of growth. I'm Matt Picheny, and I'll see you in the next video.